And today we are joined by Hans Maenhout, Investment Director of Finindus, and for me personally, the first time on this show that I'm talking to a compatriot of mine, also a Belgian. Welcome, Hans. Happy to have you.
Thanks, Maxim. Happy to be here. It's a true privilege to be on your show and to be able to contribute to this podcast.
And we're very happy that you want to join us. Of course, we talked very briefly in Brussels already last year in the EIT Manufacturing Summit special episode, and we're very happy that we can continue this conversation today. Because in the startup world, in the VC world, there's been a lot of talk about the current investment landscape, less deals, less funding. It's more difficult to raise for startups, which is definitely not different for industrial startups. So why, in your perspective, is VC investment slumbering this year, last year?
Well, I wouldn't call it slumbering that much. It is true that we see a reduction in activity in the VC world in the, let's say, the last 2 years or so. But one has to realize that, yeah, we are in a bit of turbulent economic and financial times, I would say, with everything going on in the international political and economic scene. So it's quite logical, I would say, that investors that are active in high risk areas like VC investment uh, become a bit more prudent. But on the other hand, if we actually look at the facts, and KPMG puts out this venture pulse every quarter, which are
Mhm.
very interesting numbers to take a look at, you see indeed a significant drop in VC activity. I would say starting mid 22 somewhere. If you compare it to 21 and the first 2 quarters of 22, it is a significant reduction. But if you compare VC activity levels with the period actually before that, talking 2018, 2019, you will see that even then those were relatively high levels and they were grown already over the past decade. That we are actually back at those very healthy, I think, transaction levels that we were
Mhm.
at back in 18 and 19. So I would not say that we were actually in a much reduced situation. It's only we compare ourselves to a very high peak in 21 and 22. If I look at the general landscape, and it's also confirmed by the likes of PitchBook and KPMG, there is quite some dry powder still in the market. So funds have enough dry powder to make additional investments. On top of that, there is a slightly reduced, but still a healthy fundraising within the investment funds themselves. So at this point in time, I really don't see any reason to panic.
It's more of a market correction in those sense.
Yeah, I think it brings us back to the levels that we were to expect. What is the case, I think, and the reason why there was a peak, I think, is that in extended period of low interest rates, we had traditional investors looking for better ways to employ their capital, and we saw very
Mhm.
traditional investors actually venturing into the private equity space, making private equity kind of a busy space, a bit overvalued, very hot. And then we saw even typical private equity investors moving on to the VC space in search of better returns. And I think that has
Mhm.
been fixed a little bit, if you can call it that way, by the increased interest rate environment that we're in at right now. What we do see is that I already alluded to it, is the prudency with investors, and the prudency is reflected in a number of things. First of all, I would say there's a bit more pressure on valuations,
Mhm.
and those lower valuations are needed to give actually the investors sufficient return at the end of the day. And the second thing is that we've seen the time to take that it takes to close deals has been extended. So people take a long time to make up their minds and make decisions, and it takes a long time to construct consortia, investor consortia as well. And one of the reasons there is that few people seem to be willing to act as a lead investor anymore. So especially in the industrial
Mhm.
space, we see that. But I would say, I mean, PitchBook had a great phrase, and they said that they see definitely a shift from what they call the fear of missing out and the growth at all cost to more a capital efficiency focus and a focus on financial returns in the end.
Yeah, it's a bit more healthy in that regards, probably.
I think so. Yeah.
Yeah. Now, investors such as yourself and other funds, of course, investors themselves are only human as well, right? And I would hope so. No, but investors also tend to, I think, invest a bit more in let's say trendy technologies. It sounds a bit negative, but I don't mean it negatively. Technologies that are hot in some time periods that seem to show a lot of promise and scalability. You see industrial startups on a daily basis, right? What are technologies that right now are hot?
I think the two most obvious areas are obviously AI and climate tech. Before climate tech, there was clean tech. Clean tech was not a very successful, I would say, trend. There was very few very good exits, and most of the really financial investors that got into clean tech were not very successful. Climate tech is like the better version of that, and it's a more promising version of that. But it's very hot, of course, given the state of the climate and the fact that we need to deal with it. And the fact also that a lot of people realize that technology could actually help us to resolve some of these challenges. So climate tech is literally a hot topic. The other one, of course, is the obvious one is AI, which I think recently really got into the real hype cycle. So it's still on its way up. Where we
Yeah.
see that in climate tech, actually, some of the subsections, things like hydrogen, seem to have peaked out on the hype cycle already a little bit. So they're a bit on their way downwards. There's a bit of more reality sinking in. But I think eventually they will also hit again the more upward trend in so that will be compensated anyway. Um, Personally, yeah, I'm a bit allergic to startups trying to position themselves really into the trends without any foundation. It's not because you use a lot of buzzwords that all of a sudden you become more investable and you have a better story. I mean, there has to be some truth to that. And especially as far as AI is concerned, and it's a bit my personal opinion, I think every company will have to embrace AI. It doesn't matter what business that you're in. You will be able to use it for certain aspects of your own business. So to me, AI is almost a necessity. Yeah? It will be a license to
Yeah.
operate. It will be a need to have. It's not a nice to have. And yeah, you have to use it smartly. And the best companies we see are the ones that they're very clear on their technology offer. They offer a technology, a product, um, a service that works, and they've proven that it works, and it also resolves a challenge or a problem of a big group of people, customers, that are also willing to pay for it. So it's that technology uh, market, and you have to cater to a certain need in the market to be successful, and you need to do that in the most efficient way. And if that means using AI, you have to use AI, and you have to do that in the most sustainable way.
Yeah, yeah, no, I think that artificial intelligence, especially in the industrial space, has a lot of promise in terms of efficiency gains, probably.
Yeah.
Well, talking about climate tech reminds me of a report that I read, I think it was late 2023, by PwC. So
Hmm.
they also have this state of climate tech report every year. So you see the same trends that we talked about: drop in funding, less deals overall, although in relative terms more investment in climate tech compared to other sectors. But what really struck me was the following. So they took statistics from the IPCC reports, and they looked at the relative share of emissions of 5 sectors. So they talked about industrials, built environment, food and agriculture, mobility, and energy, I believe. And they compared the share of emissions for these 5 sectors to the share of recent investment in these sectors. And what was interesting was that industrials, which includes manufacturing, of course, accounts for about 34% of all emissions, while only 14% of funding goes to climate solutions in the industrial space. If you include the built environment, I think it was about 15 or 17%. So in combined total of half of the emissions, with a combined investment share of about 20%, I think, where mobility, electric vehicles, the more forward-looking investments into flying taxis and these kind of things, has I think it was about 50, 45, 50% of investments, even if their share of emissions was much lower. So I think there is also a little bit of a mismatch here in terms of the startups, or either the startups addressing the high emission spheres, or maybe the investors investing in these solutions. This is, I think they called it the carbon funding gap or something in this report, which I thought was very spot on. But I think that begs the next question: why is it so hard for industrial startups, hardware startups, to raise money in general? It's not only the investments environment right now, but why is it in general so difficult for them to raise money?
Yeah, it's always been the case, I think. Industrial technology has never been sexy. Actually, the fact that
Yeah.
climate tech exists now in some way has given it more attention than it has ever had. And we have been active investors into industrial technology since 2006, and we were one of the few. I think I'm happy to see there's much more players now. So actually, that financing landscape has gotten broader. But I agree with you. It still remains a challenge. I see the challenge on two different levels. I think the first one is that is the capital intensity of these type of to develop these type of technologies, upscale them, and eventually roll them out is so high that for a lot of the typical investment funds, it's just not be beyond their means in terms of absolute amount of money that needs to go in to really develop a technology from A to Z. So that's the first reason. I think the second reason is also the time that it takes. I mean, there are no shortcuts in developing industrial technology. Let's face that. And no shortcut means that you have to give it the time that it needs. And especially in terms of financial investment funds, but also some of the corporates, to be honest, they set themselves a fixed time limit. So they are in existence for 5 years. They want to invest for 5 years. They want to disinvest for another 5 years. Then they may have two extension options to add another 2 years or so. In 12 years is really the maximum time they can be into a company. And but in reality, it's always shorter, huh? Because the fund is already ongoing, and so they fall somewhere in that cycle. And we see that that's often not enough time to bring these type of industrial technologies to their true value. Which means if for a financial investor, if they want to exit along the way, they will have to exit at a suboptimal point, which then also questions the returns that they will get. So an investor that is not willing to either put all the capital in, which is very capital intense, and ride out the ride all the way to the end, for them it's a bit less attractive. Hence, I think also the reason why, yeah, there's less of attention for these type of technologies because
Yeah.
it is just more complicated and difficult. But on the other hand, I think it's actually recently gotten, fortunately, a bit better. And the reason why it got better is twofold. First of all, we have seen the growth of CVC, of corporate venture capital, over the last couple of years. And corporates, of course, have a different mindset and have a different interest. So if they come across a technology that can significantly help them either on operational efficiency or on carbon emissions or environmental impact, they are more tolerant and willing to first put more money in it, and secondly, ride it all out until the point that they can actually use the technology. So the growth in CVC has actually helped a little bit making funds available in industrial technology development. I think the second one is climate tech. It has become such a burning platform that people do realize that they need to put effort in developing these technologies, and even financial parties. And you see even financial VC funds now come up with evergreen structures or funds that are 15 or 20 years, because they just know that if they want to tackle these type of technologies, this is the timeline that they need to look at. I mean, decarbonization is just not a software thing. You know, there's great software out there that can help us to do all this, but there is always going to be a very important hardware component, and financing hardware is, yeah, it's not the easiest thing in the world, I would say.
No, 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 but you're right. There are a couple of very good developments in that regard. You know, these evergreen funds and longer cycles. I think it's a very, very good development that hopefully can help lessen or close this carbon funding gap because it's
Yeah.
necessary. But if we dive into manufacturing technologies a little bit, so you're one of the still not many funds that really invest in manufacturing technologies. What are the specific difficulties of manufacturing related technologies?
Yeah, I mean, I think I already alluded to it a little bit. It is the capital intensity and it's the time intensity. Because if you look at true process development, I mean, we have a link to the steel industry, as you know. So these are very old processes that have been optimized over more than 100 years, let's say. Um, so, you know, to develop new technologies for that is it's a time-consuming process, and you want people that are in the business want to be careful, and they're just not going to take on a new technology because it could upset their operation. It could all of a sudden shut down their plant if it's not all done right and scheduled right. So, and that's whole de-risking process is capital and time consuming. Basically, for me, it all starts with a proof of concept. So you have a problem, and then you think you have a solution, and you kind of make a proof of concept of what this is, how this is going to work, and you prove basically that the technology work. Ideally, in that proof of concept stage, you will also secure IP, and you can you can demonstrate first market interest. You know, that's what needs to be done in that first step. Then there's a second step that takes that proof of concept and makes it into more like a pilot plant. So a first small scale demonstration of the real process. It is still going to be like standing on its own a little bit, hopefully a bit integrated into an industrial site, because sometimes you need certain gases or certain flows that need to come to you, and to handle that right, you have to do that almost in a very industrial environment. So you're going to build that pilot. That pilot can easily cost a couple of tens of millions of euros. So it is already capital intensive right there. And the goal of that phase is to really demonstrate the process as such and build the experience level within the startup, and to get the right resources in place, both internally, externally, and basically prepare for upscaling, making the same thing only bigger. So you learn from the pilot, you then design your first demonstration plant, and the first demonstration plant is then, yeah, likely going to cost you more than 100 million euros to build. And that already points a little bit to the difficulties that we have in trying to get all of this financed, because the early stage VC investors will not have the hundreds of millions that they need to put in at the end of the day. So that is quite a big challenge, I would say, to bring this through this process. I know there's a lot of buzz right now about first of a kind plants. That's the new buzzword. But I think people that have been in industrial technology development, for them, this has been a fact of life for many years and decades. Is that is a challenge to build a first industrial facility to really prove out the technology, because it's only when you've done that you can give it over to I would say bigger investors, infrastructure type of investors, because they are typically not willing to run any technology risk, and they not even commercial risk. If you really want a project finance something like that, you need proven technology, you need proven supply, and you need committed customers.
Yeah, there's a lot of extra risk, different kind of risk there that you don't see in a lot of other sectors, of course. There's this infrastructure risk. You build a plant and then all of a sudden turns out that your technology that was proven in a lab doesn't work on a larger scale, and then you have this huge building there. Who's going to own it? Who's going to use it? Yeah.
Yeah, exactly. And therefore the importance to gradually scale it up and not go from just the proverbial lab setup all the way into the industrial setup, because you just know that doesn't work. But taking all the steps takes time. I think luckily, I mean, there's a big financing challenge there, and to me that is the biggest challenge that we have today, because venture capital investors are willing to take the proof of concept through the pilot risk. That whole technology risks, that's what we do for a living. We feel comfortable. If we understand the risk, we feel comfortable taking it. The problem is that the venture capital investors cannot put down the hundreds of millions that you will need to build a demo plant. So somewhere there's a discrepancy between the investors willing to finance the first phase and the investors that you actually need to be financing the second phase of that development, the larger scale, where much more money is involved. And over the past couple of years, a couple of interesting tools have been developed. Just to name a few, EIC financing, EIB venture debt, the Innovation Fund, Breakthrough Energy Ventures Catalyst Program. So there have been some financing tools put in place, in particular to address this stage in between. But I would argue that it's still not enough, and yeah. Not that we have to fund every single process or project in this way. Obviously, we need to restrict us to the good ones, the ones that are well prepared. But I think still more money will be needed.
Yeah. One thing that we haven't talked about yet is the kind of hybrid structure that Finindus has. You act like a corporate venture capital fund of ArcelorMittal, which I think is the second largest steel producer worldwide, and as a financial venture capital fund funded by the Flemish government. So Flanders being one of the regions, there we go, in Belgium. So you're uniquely positioned to see both types of VC funds. So according to you, what are the differences between both?
Yeah, I think a lot has been said already about the differences between the corporate VC and a financial VC. I mean, the easiest thing, of course, is to say, well, a corporate VC typically wants more than just financial return, and their main goal is strategic return, which is also their biggest challenge, to be honest, because how do you measure strategic return? On the other hand, you have the financial VC companies that are more, they're interested in the financial return for their LPs, and so that takes priority, I would say, over everything else. I like the combination of the two. I wouldn't say that we behave like both, but yeah, we're indeed a hybrid, and but I like the presence of both actually on a cap table in a company that we're in, because on one side you see the financial VCs, they bring in financial discipline, they bring in governance discipline, they bring in a very pronounced sense of urgency and value creation. And they're really saying, okay, I need to show value creation because otherwise I'm never going to get to my financial return. So and last but not least, and that counts for both, but they're quite significantly different often, is they also bring a good network. A good financial investor will bring you a good network that will be very helpful in further funding rounds because they know the investment landscape. But very often it goes above that. They often also have, because they've been operating in this area for a long time, they will also have very relevant industry contacts. So the networking aspect for them is also important. If you look at it from a corporate side, a corporate would typically bring a lot of know-how and insights from a technology perspective. because the reason that they invest in you is because they understand the technology and they may have adjacent technologies in house, or so they bring a lot of expertise and know-how in that sense. They also typically know the market quite well that you will operate in, both suppliers and customers, and they can help a startup tremendously creating the right contacts in that in that structure. What I see the biggest challenges is, but then specifically talking about CVC um, and their relationship to a startup. What I see the biggest challenges is first of all it's the pace of activity. Is A startup lives day by day. They need to show results the next day. A corporate works on like an annual budget cycle, especially if you
Mhm.
work with R&D people. Hey, if we don't do it this year, we will put it in the budget for next year. Now that is an unacceptable attitude for a startup because next year they will be dead if they don't do anything.
Yeah.
So that is one big challenge. I think the second challenge that you will face working with CVCs anyway is that uh, the people in the venture group, they're incentivized to take risk. It's their job to find these opportunities that people know they will be risky, but there's a pot of gold at the end of the rainbow. If this works, this is very valuable. Um, but the disconnect is then if they are trying to bring this technology within their organizations, and you start to deal with people in operations that are not incentivized to take risks, they're incentivized to have a plant up and running, producing consistently, meeting quality, safety, delivery requirements. Um, so there you see that even for CVC groups, it is difficult to take their own portfolio companies and actually make them part of their own organizations. And I think that
Yeah.
is one of the major challenges that um, most of the startups that get financed by CVCs
Hmm.
struggle with. Of course, I mean, being associated with the CVC, apart from everything that I already said, the networking, the know-how, and so forth, it can be a very important signaling function. Uh, if you're active in a certain market and you see that one of the top players in that market has actually, bothered to put money into your company, that is a very strong signaling function to the market, and that creates immediately a lot of street credibility for the startup.
Yeah. 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 So from the corporate perspective, for the CVC perspective, what are the reasons a corporate such as ArcelorMittal, for example, would set up a CVC fund and invest in startups?
Yeah, I think corporates and industrial corporates have always realized that innovation is important, and that's why they've always put a lot of money into R&D, basically developing their own new technologies, own new products, and new services.
Hmm.
I think at some point in time, another way to bring in innovation is basically buying companies. You can say, okay, we don't have these capabilities. We have this other company here that hasn't. We can buy them. So you have R&D on one side, you have M&A on the other side. I think at a certain point in time, people have realized that there's interesting technology developments happening on the outside world
Hmm.
where they
Yeah.
can actually significantly contribute, but they might not be willing to make a full commitment to it yet. And that's where I think, that's where open innovation was born as a concept.
Hmm.
And to me, VC is a type of embodiment of this open innovation idea. And you go a step further that you do not only cooperate with these open innovators, but you also give them money to work on their
Yeah.
technology. So that's I think that is one of the reasons why corporates do it. It gives them a way to get a front row seat on the development of new technologies or new markets or new business models without having to commit too many internal resources, so no R&D, and without having to shell out too much money, meaning M&A, and Yeah, they have a front row seat, so if this thing goes in the right direction, they're always open to make an offer for the company, and I'm sure if the offer is right, and if it's market related, other investors will definitely be happy about that.
Yeah.
The main challenge I see with CVCs is that it's hard to prove the value. As I said, they're about creating strategic value, and how do you measure
Hmm.
that? That is the most difficult thing. It helps quite a bit if the CVC can also show financial value. If they can show financial return, then you see the longevity of the VC initiative within the corporate is much longer, because it's not a cost center, it's more of a profit center by itself.
Hmm.
But often you see, and I sometimes jokingly say that CVC is a religion. You believe in it or you don't, because it's hard to measure what the real impact is. And in fact, you see that often when there's difficult times in the market, there's a CEO change, there's a strategy change within a company, always CVC activities get questioned.
Hmm.
So on these, and then it helps, I think, to also have a good financial story behind it.
Yeah.
Um,
So it's an interesting analogy. I would not have thought about that. So internally, then you're the preacher or the evangelist for the CVC.
yeah.
Uh, we often get questions from startups that are raising whether they should approach or get involved with CVCs. From your point of view, being a CVC, what are the advantages and disadvantages of a startup for a startup of collaborating with a CVC?
Yeah, I think coming back to some of the previous remarks, it is the
Mm-hmm.
branding, the stamp of approval, or the stamp of quality of having a reputable player in your industry endorsing you, and not just by words but by putting in actual money. I think that goes a long way. It is creating these relationships both within the corporate, because a CVC is able to put you in contacts with the right people within R&D, CTO office, operations. So they should be able to bring you in contact with the right people that are open to maybe try out the technology or build a pilot somewhere within their company, but also to the outside world. So they know the suppliers, they know the customers, and they're often willing to share that knowledge and help the company forward. Um, of course, there's always a bit of a danger. Say that you let a CVC in that is related to one potential supplier. There's the risk that you would deter other potential suppliers and say, "Hey, you're already working with X, that's our competitor, so we don't want to work with you anymore." Same thing on the customer side, if it's one of your customers. But I think, I mean, over the years, CVCs have become much more disciplined, and the vision has actually crystallized out that the days that people wanted to have preferential exits, or exit rights to buy the company, that they wanted exclusivity, that they were kind of intrusive and would actually deter competitors from working with the company. I think those days are gone, and everybody understands now the way this game is played, and that it is people are trying to play it on a arm's length level. So I think that risk has actually been diminished.
So, if, as a startup, this would be perhaps a red flag if CVC would want preferential exit rights or these kind of
Yeah,
things. Yeah.
yeah.
Hmm.
I mean, it's always going to be a problem in future fundraising. Eh? I mean,
Of course, it's a negotiation always.
yeah, I
That will
mean,
never change.
and it depends on how you describe, of course, preferential exit rights. If it's a right of first refusal, it's one thing. If it's a right of first offer, it's another thing. If it's what I do often see and what I can live with is that somehow it is assured that they get a fair chance to be involved in, if it comes to like a bidding process, if you want to
Hmm.
call it that way, that they have a fair chance to being involved. But let's be honest, if the CVC invests, then they often either get a board seat or they get a board observer seat, or even if they just talk to the company on a regular basis, they will be the first to know that
Yeah.
the company is evolving towards an exit anyway.
Yeah.
So I think in reality that's not too much of a problem.
Okay. So maybe as a last question, because I think this might be very interesting for the startups that are listening to this episode. If you were a startup, an industrial startup, talking to a CVC, what would be the things that you would look out for? What would be the questions that you would ask the CVC as a startup?
Now, well, first of all, I would like to understand, of course, their rationale and why are you investing? What could this technology bring to your company? And ideally also come up with some post-investment action plan. What are we going to do together? And I know certain CVCs actually want a GDA in place before they even make an investment. So in that case, the post-investment action plan is already quite clear. But that's one thing. That's also not a guarantee that this will happen. And um, there's a number of things that I would, and maybe very practical things, but that would help me understand a little bit how they think and how they operate. I like to understand who the CVC unit is reporting to. I've seen companies where it actually reports to the CFO. I've seen companies where it reports to R&D. There are companies that it goes directly into the CEO, or it's parked in some kind of an innovation department, because that goes a long way to understand what their priorities are. If it's a CFO thing, the risk is that they're gonna look at it from a financial perspective.
Yeah.
If it's an R&D thing, the risk is that you will never get into the operations. If it's directly to the CEO, you might be in a position where the CEO actually forces this organization to do certain things. So understanding the dynamics, where does this CVC activity fit within the organization, and how much leverage do they then have for the organization to move? And I'm going to quote one of my former Chevron colleagues that said at one point is that it is easier to get venture capital money from a corporate than it is to get a purchase order. And you actually see that people get CVC money in, but they still do not succeed to sell any of their products to the corporate that has just invested in them. Where I would think often the PO is more valuable than the venture capital money, because the PO will lead to an actual installation, will show industrial relevance, operational experience, and that will be more valuable in rolling out the technology. So understanding that dynamic. I think a second thing is how long have they been doing VC? Is it like they're in, they're out, they're in, they're out? Because getting them in for this round is great, but it would be nice if they can, continue further investment rounds as well. And to understand a little bit what their track record is in that respect. So how long have they been doing it? But also what's their financial return? Because the worst thing that can happen is that you have a very strong CVC that takes a big part of your cap table, and then the next funding round to say, think about the religion thing. We changed our mind, and yeah, we got out of VC. It happened with a lot of big corporates. Then all of a sudden you have a difficult story. You have these guys that invested in you, and now they're not continuing to invest. How do you explain that?
Yeah. It's
That
a
a
bad
vote
look.
is that a vote of distrust into the technology, into the company, or is it just because they happen to change strategy? If you understand what their track record is and also what their financial return is, if they have a good financial return, the chances that they will ever stop the VC activity are more limited than if it's like, more of a cost center than a profit center.
Yeah.
Yeah, the longevity of the investment managers, maybe it seems like a little thing, but like many businesses, VC businesses is a people's business. You trust each other, you work with each other through difficult times, and you try to make it into a success, and you build up a personal relationship. Don't underestimate that. The investment manager has to defend this file in front of his committee time and time again. Um, and so he's your biggest advocate within the organization. And it's important that I've seen cases where companies have lost their main contact within the CVC group because they disappeared, and either they left the company or they went on. Some companies use the CVC group as like a training position or training ground, and then they circle them out quite quickly, and then all of a sudden you lose your biggest supporter, and then yeah, your file gets then given to somebody else. But yeah, you always suffer then from the not invented here syndrome. It is not their deal, and they don't take that much personal pride of it. And that especially is the case when things are not going as well as they should. Then the question
Yeah.
is the new person willing to go to bat as much as the original contact that you did the deal with did. So that could be a consideration as well. And then last but not least, and it's something that we offer to our companies that we invest in as well, is we do a lot of ref calling to customers, suppliers, technology providers, you name it. Yep, do ref calls on their portfolio companies as well. And do not only talk to the ones that go well, but also talk to the ones that don't go that well. And then you understand how they behave and what their way of working is.
Yeah. Yeah. So these are a couple of very, very good questions. And just to make sure that there is no negativity here, because you touched upon a couple of risks. And it's, of course, as a startup, also extremely important to understand the risk of working with a CVC or a financial VC or anyone who invests in your company. Circling back to what you said before, the network, the connections, having this kind of big corporate in your industry that supports you and that's willing to invest in you is still a very, very good look and can help you tremendously as a startup. But as always, VCs do their due diligence, and as a startup, so should you.
Absolutely.
I think that's a nice ending point for our conversation today. Very, very interesting, Hans. Thank you so much. And I think this will be of great value to our entrepreneurial listeners that are tuning in today.
I truly hope so, Maxim. It was my pleasure to be part of it, and thanks again for the invitation.
Thanks for tuning in. If you like what you're hearing, make sure to subscribe to The Art of Making on the podcast platform of your choice. We're also more than happy to hear from you, so reach out through the EIT Manufacturing website, that is eitmanufacturing.eu, or find us on the usual social media channels. Take care and talk soon.